Welcome back. Next up, we have the Very Good Food Company, Inc. It trades on the NASDAQ under the symbol VGFC and on the TSXV under the symbol VER.Y, and is an emerging plant-based food technology company that produces nutritious and delicious plant-based meat and cheese products under Very Good's core brands. That's the Very Good Butchers and the Very Good Cheese Company. Please welcome its CEO, Primal Rana. Welcome, Primal.
Thank you, Anna. So today I will be providing you with an update of recent changes at Very Good Food Company and the Very Good Butchers. Here's a copy of our safe harbor statement. Our mission is simple. We want to show the world that plant-based eating is both delicious and approachable. We want to be the forefront of the plant-based revolution. By offering our consumers plant-based food options that are delicious and nutritious, we would like to have millions rethink their food choices that are both better for them and the planet. Here are some important investment highlights. A growing market opportunity. I have been in the food industry for the past 25 years and have not seen a product as delicious and as consumer-friendly as our products are. We have a strong brand affinity in Canada and other key markets. Increased distribution at Loblaws, Save-On-Foods, and Whole Foods Canada has allowed us to get our products to the consumers that we are targeting. Our superior taste, quality, and wholesome ingredients allows our products to be ranked better in terms of taste and quality against industry titans like Beyond Meat, Impossible, and Gardein. A proven track record in innovation. We have won several awards for our Butcher Select meatballs and ground pork. Here's some investment highlights. A growing market opportunity. I've been in the food industry for the past 25 years, and I've worked at companies like Gardein and Dea. This product that we make at the Very Good Butchers is one of the best that I've consumed in my career as a food scientist. A strong brand affinity in Canada and other key markets. Over the past couple of months, we have seen increased distributions at Loblaws, Save-On-Foods, and Whole Foods Canada, as well as making inroads in U.S. market retailers. A superior tasting product, high quality and wholesome ingredients allows our products to be ranked better in terms of taste and quality against industry titans like Beyond Meat, Impossible, and Gardein. A proven track record in innovation. We have won several awards for our Butcher Select meatballs and ground pork. Our $25 million investment in our state-of-the-art Rupert facility will allow us to increase our capacity over the next few years. And finally, a refocused go-to-market strategy for a wholesale review stream. Company history. In 2016, Mitchell and James started selling products on Denman Island, BC, Canada. This small island only had a population of 1,000 people. They used farmers markets to entice our consumers to start eating our products. In 2017, they were able to use Kickstarter and raise funds to open a restaurant in Victoria. In 2018, they raised additional funds through FrontRunner and started an online monthly subscription service. In 2019, raised additional money and started a small production facility in Victoria. 2020 completed an IPO, CSE, and closed a deal with Sobeys Incorporated, a large supermarket chain in Canada. In 2021, started trading on the NASDAQ and started selling cheese and got the marketing in-house and brought marketing in-house. The rapid growth was due to a very popular product and huge following. It's a testament to our customer loyalty and products which are still growing. Recent changes in our company. Starting at the end of Q1, we started a strategic decision to consolidate all production under one location. As of the end of Q2, all production is being carried out at our Rupert facility in Vancouver, BC. The two restaurants have been officially closed. Although we still have access to our Patterson location, we are considering potential options on how best to utilize this location. We also made a decision to move away from e-commerce model to a wholesale and food service model that should allow us to become cash neutral and eventually profitable by 2024. On April 4th, 2022, VERY announced the departure of the two founders, Mitchell Scott and James Davison, from the board of directors and subsequently from the organization, although both are still significant shareholders in the company. On July 4th, 2022, I was promoted to the role of CEO from the outgoing Matt Hall, who served as interim CEO. Prior to this, I was responsible for operations of the company and as part of the executive committee that was formed to help the company move forward in a new direction to a more sustainable growth plan. On July 12th, 2022, VERY added to the leadership team by announcing the appointment of Pratik Patel as its new CFO. As the company has pivoted to its new focus strategy on sustainable growth and profitability is focused on the three pillars approach of stabilizing, right-sizing, and optimizing its business. The initial steps of stabilizing the business was a securing of $6 million US in June of 2022. As mentioned earlier, right-sizing initiatives included the consolidation of all operating units under one location at the company's 25,000 square foot state-of-the-art Rupert manufacturing facility. In Q2, we also witnessed increased distribution in wholesale and retail markets, as well as making inroads in food service opportunities. Our primary product portfolio, specialized knowledge in plant-based protein with a robust pipeline of products aimed at flexitarians, a rapidly growing sector of the market that looks at reducing its overall meat intake. Products rank better in terms of taste and quality against some of the large competitors that we have in the market, including Impossible and Gardein. We have a diverse portfolio of clean, healthy plant-based foods, including steaks, burgers, sausages, meatballs, and non-dairy cheeses. Targeting to achieve a non-GMO and kosher and gluten-free certification for all of our products by the end of 2023. The Very Good Food Company products produce products under three distinct categories: the Very Good Butcher, Butcher Select, and the Very Good Cheese Company. Here are some of the products that we have launched with this company, and the newest and most exciting products are 2-pack steak and our ribs, which come in 3 different flavors. In addition to our gluten line of products, the Very Good Food Company produces a line of gluten-free products under the Very Good Butcher's Butcher Select label. These include a variety of products, including its award-winning meatballs and a cut above pork. All products are non-GMO, gluten-free, soy-free, and kosher. And finally, our product line, the Very Good Food Company, produces a line of cultured cheeses under the Very Good Cheese Company label. These products are perfect as an addition to any holiday meal. As the meat production is a large contributor to greenhouse gases, Very Good's vast offerings of sustainably sourced plant-based protein alternatives clearly illustrates its commitment to environment and a reduction in greenhouse gas emissions. Besides being a healthy part of our regular meal choices, Very is continuously driving towards sustainability. This is achieved by having a hybrid work environment, allowing its employees to work, which in turn reduces fuel consumption of having to drive into work every day. Very has made considerable investments in its unique fiber trays used for packaging its Butcher Select products. It is our goal to achieve biodegradable packaging by the end of 2024. This can be achieved by finding the right packaging partners. Our proven track record is based on innovation. We have created health food options without compromising taste or texture. Many of the products are non-GMO, gluten-free, soy-free, and whole ingredients and kosher. Our R&D team is led by Celeste Trujillo, a seasoned R&D professional in the local food industry. She has over 15 years in the food industry and joined the Very team in 2019 after spending time at Daya Foods. Although we have seen a slight downward trend in the plant-based meats market sector, we feel most of this is a result of some very poor products in manufacturing in the space. Current plant-based meat sales are around 1.4 billion and growing at a rate of 74% over the past 3 years. The overall market opportunity for this sector is around 16 billion in the US by 2030. The Plant-Based Association feels that most of this growth will come from the growth in flexitarians. 21% of US customers have heard of plant-based meat products 1 to 2 years ago. 41% of US customers initially purchased a plant-based meat product out of curiosity. 66% of consumers believe plant-based meats are healthier than animal meats. 73% of consumers seek out natural foods with simpler, cleaner ingredients. 31% of consumers are flexitarians who use plant-based meat because they like to have days without eating animal-based products. 71% of consumers are concerned about long-term health impact of artificial ingredients. As we consolidated our operation under the Rupert facility, we have a 45,000 state-of-the-art manufacturing facility in Vancouver that has a throughput capable of producing 3.2 million kgs annually, potentially to be able to double that production to 6.4 million kgs with a $1.5 million capital expense. Facility required $25 million investment of state-of-the-art European and North American-based equipment and infrastructure. We are currently underutilizing our location in that we only use 15 to 20% of our capacity. This excess capacity has allowed us to consider private label and co-manufacturing opportunities. As VERY has made the shift away from e-commerce model to a more traditional wholesale retail-based business, we have seen increase in retail doors that have opened over the past 6 months. We are currently in excess of 4,000 retail stores with a target of 10,000 stores over the next few years. We have also increased our food service efforts by having our products offered by several food service distribution partners. As we have made a shift towards wholesale retail sales, we are already seeing positive results with 117% increase in our Q1 2022 to Q2 2022 sales numbers. Here's a recap of our capitalization table. Over the past year and a half, VERY has been able to show a successful ability to raise capital based on our unique products. Most recent raise was 8 million Canadian placement with H.C. Wainwright. Prior to that, VERY was able to raise 30 million in Alliance Global Partners. We are currently looking at raising additional funds to get us to a point of profitability. We are facing similar challenges in the market as is the rest of the plant-based sector. We have seen a decline in our share value, but feel that we are at a point where the share value is stabilized. As the sector sees potential consolidation as it emerges from the downturn over the past year, we are positioned in a unique situation which allows our production plant and capacity to be one of those companies that reemerges from this current downtrend. Recent customer wins show a steady increase in our wholesale retail distribution network. Some of these wins include Vice Markets, Giant Company, Myers in the US, and most recently, we have nationwide distribution at Whole Foods Canada, as well as increasing our distribution with Loblaws, Sobeys, and Save-On-Foods. Here's a quick recap of our team. Myself, Jordan Rogers, who's our Chief Commercial Officer. Pratik Patel, who I mentioned earlier, is our new CFO. And we have a board of advisors as well as our board of directors. That concludes my presentation. Thank you for your time. And if there are any questions, I'll hand it back over to Anna.
Great job, great presentation. Yes, let's dive right into questions. Let's see, earlier this year, Very Good announced a right size, stabilize and optimize strategy. Can you give us an update on how that is going and any progress?
We have made significant progress in right sizing of the organization. We have fully integrated all of our operations under the Vancouver facility, which we refer to as Rupert. The consolidation of all operations has allowed us also to realign our headcount. So we were able to reduce the number of employees that we had from 212 employees down to just under 100 employees, which allows us to manage our cash burn. As we moved to stabilizing, we were able to raise 6.5 million US. And as some of the slides indicated, we've made some significant progress in optimization of our business by winning some large key retail partners in the US with Vice, Giant, and Myers.
Fantastic. Talk to us a little bit about some difficulties and challenges you're facing and how you're overcoming them.
The biggest challenge we have right now is we built an engine or a production facility that was quite large. So we are seeing sort of only about a 15 to 20% capacity utilization of those facilities. So we have pivoted, and we are looking at doing co-manufacturing and or private label partnerships with some companies that didn't have the capital initially to build out their plants. So they're utilizing some of our excess capacity at this point in time. Some of the other challenges that we face is we made significant investments in ingredients and supplies over the past year. And so we are obligated to pay for those. And we're also obligated to pay for services that we had engaged in when we were a much larger organization. So we've had to pivot away from those over the last couple of months.
Makes sense. So earlier this year, VERY.V stated a commitment to focus on the wholesale and food service revenue channels. Tell us why.
We found that our e-commerce sales required a large CAC or customer acquisition cost, and we weren't getting the repeatability over the short period of time that we were anticipating. The cost of delivery to all locations of all products in all sizes made that model somewhat unprofitable. So what we've done is we've shifted to a wholesale environment where we're trying to get our loyal e-commerce customer base, which is around 400,000 subscribers, to pivot to more of a retail engagement. So as we bring on our wholesale partners, that will allow our consumers to reach out to those retailers and purchase on a daily basis, as opposed to having to purchase 2 or 3 shipments at a time. So that gives a lot more flexibility to those individuals. For myself, when I shop, I prefer to go buy what I need, or my family tends to buy what they need on a daily or a couple of days at a time. Having to buy something on a wholesale, on an e-commerce model, you tend to buy large quantities and you may not get through it as quickly as you would like to. So this provides a lot more flexibility for our consumer base.
Right, absolutely. So last week, VERY.V issued a press release stating that you initiated a process to evaluate potential strategic alternatives in hopes to maximize shareholder value. So that could include the acquisition or merger with an industry partner involving all or part of VERY.V's business assets. Can you explain this, and what's your objective?
As we move towards stabilizing the business, we needed to be open to all opportunities that may come in front of us. And so we wanted to make sure that our shareholders and our stakeholders were apprised of that. And we felt that it was our due diligence to ensure that they understood that that was a possibility as we move forward. And that was the reason why we made the statement that we did last week.
And can you give us an update on your e-commerce channel? And will you continue to wind down, and why?
We will continue to wind down the e-commerce channel. Main reason is we do want to focus on production towards our wholesale market. Our desire is to wind everything down probably by the end of this year. We have set targets that we must meet on a monthly basis as far as revenue and cases sold. So depending on how that goes, we have several sales that are going on right now. The back to school sale, which comes on the heels of our summer sale, which has shown good revenue levels. Moving forward, though, we do anticipate, as we bring on other partners to carry some of our products, there are partners that we're working with that could potentially pick up some of our e-commerce distribution through their environment. And that's part of the reason why we're shifting away from our own e-commerce management and allowing partners to step in and cover those areas for us.
Makes sense. When do you suspect that VERY.V is going to be profitable?
Our target It's currently moving towards cash neutrality and eventually profitability. The timing of this is dependent on ongoing strategic directions of right-sizing, stabilizing, and optimizing the business. We are confident that we should be able to get to a profitable model within the next, I would say, a year to 18 months is our target at this point in time.
All right, good luck with that. And who are you seeing as your biggest competitors today? And how are your products superior? I know there's a lot out there. I buy a lot of them. So tell us about how you stand out.
The largest three competitors that we see are Beyond, Impossible, and Gardein, simply because they were in the market first. They had some strong inroads. Moving forward, or with our products, we have a superior tasting product, texture, and quality. We use high quality, non-GMO and kosher ingredients with minimal processing. So that's what sets us apart. We have wholesome ingredients, less processed ingredients, and our texture and taste is not compromised because of that.
Well, that's a big deal. Got to read those ingredients and in between the lines as well. So I appreciate that for myself and my family, and I'm sure our viewers do too. So thank you so much for joining us. Do you have any closing remarks?
No, thank you. I think the world of plant-based food is immense. I've lived in this category for 25 years. I started off at Nature's Path Foods, moved my way through Gardein and into Dea. Every year I see sort of advances that I haven't seen in the past. And the quality of the products that we are currently making is far superior than what I've seen in the market in recent years. So I think once we get out of this sort of short little blip in the economy, and that's not just necessarily plant-based, it's the economy in general, we will see a rebounding and a desire to seek out plant-based products moving forward.
I hope so as well. Thank you so much for joining us, and please come back again in the future with some updates.
Awesome. Thank you. Take care.
All right, everyone, stay with us. We'll be right back with our next presenter.